Hello, friends. Thanks so much for tuning in to our home buyer crash course. This podcast is a lot of what we talk through with our home buying clients at the first meeting. And we found it really helpful to basically record all this information and put it out there. It's been one of our most popular podcast episodes. And speaking of that, if you're watching on YouTube and you want just an audio format, you can search Grey Rock Realty on Spotify, Apple Podcasts, wherever you get it, and should pop right up. And this is the home buyer crash course. Just to give you an idea of what we're going to talk about today, we're going to talk about current market conditions. We're in December 2025. The market's changed a lot, especially in the last 6 months, the last half of 2025. Big changes. So we'll discuss how much you can negotiate off a house right now, what it feels like to shop, what inventory levels are like, kind of give you some context. That's usually where we start with clients. Everybody's curious. They see a lot of price drops, but they don't really know kind of the brass tacks, and we'll talk about that. Also going to talk about common mistakes that people make with mortgages. We're going to talk about the fear of the market crashing. It's a big thing, I think, on a lot of people's mind is this the right time to buy? So we're going to talk about that. How much your mortgage closing costs will be, how to do the best research you can possibly do on a house. There's a lot more that you can do over and above just a home inspection. And there's a lot of particular things to think about during a home inspection that we don't think people know about or are coached well on when they're doing the inspection process. And then how to use pricing. We do a lot of pricing research on homes. How do we use that research in order to negotiate the best deal? And we're going to talk about real estate commissions. That's something that real estate brokers don't talk a lot about. I think it should be talked about more. And so we'll dive into real estate commissions and how to structure a real estate deal, how they typically are structured, so that you can understand, when you're walking into an open house, or if you don't have an agent and you buy a listing, that's, I think, a particular thing that needs to be discussed more. So we'll go through all that. So appreciate you guys being here. Again, market conditions, I think that's where we need to start. Very interesting, the last half of 2025, how much the market has changed. So over the last 8 to 10 years, the Northern Colorado market in particular has really been beating up home buyers. I mean, even well before COVID, we were seeing bidding wars. We were seeing very significant rates of appreciation. And then during the pandemic, things just went absolutely nuts, as everybody knows. And then interest rates went in late 2022. Rates spiked from 3 to 4% all the way up to 7 or 8%. And the market was impacted, obviously slowed things down considerably, but we really didn't see prices fall. There's always a certain amount of people that need to buy homes, and Northern Colorado always has fairly limited inventory. And so the demand was still enough to keep prices up. We talk a lot about dual income households when we're thinking about the resiliency of our market, and the fact that there's a lot of home buyers out there that are dual income households. Both spouses are making whatever, $75,000 or $100,000 a year. Maybe they're making $200,000 combined. That's a lot of purchasing power, even though people obviously don't like the high interest rates. For those that had to move, they were still able to do it, and that was enough to keep our market cranking along. We were still seeing bidding wars even when we were at 7.5% interest rates in some cases. So it was very surprising. I think if you would talk to most real estate professionals and they would tell you, hey, rates are going to go to 7 and 8%, you would say, man, prices must have absolutely tanked. Well, they didn't at that time. But now we have been in that high interest rate environment for the better part of 3 years. And inventory has slowly been climbing over that period. And I think it felt like in 2025, especially at the end of the year, kind of collectively buyers said enough is enough. We're not going to buy a home unless we're getting a really good deal. And so the market has really shifted. So to give you some context as far as inventory levels, in the bottom of the pandemic inventory, so inventory got extremely low in Larimer and Weld County, we would have about 350 homes on the market in those counties per county. So about, 700 or 800 total. Right now, we have about 1,200 homes on the market in each county. So our inventory has, more than tripled. It's up significantly. You're seeing more price drops. You're seeing an average of about 60 days on market across the board. There were times when our average days on market was like 10. It was pretty unbelievable. But that's all changing, as I'm sure you've seen if you spent any time on Zillow. The average listing is getting about 97% of list price, so people are knocking about 3% off the price of the home on average in Larimer County. In Weld County, that is about 98% of average. So, when a lot of times people ask how much I can negotiate or how much can I offer on a particular house, and that really depends. A lot of times you'll see a new listing come on the market and somebody will think, wow, it's a great house, but I think it's priced too high. Even if it is priced too high, if it's a brand new listing, it's going to be pretty hard to negotiate a significant amount of money off the price of that house. You can certainly try. We had an instance recently where we put a listing on the market. It got a lot of activity in the first few days and we were getting multiple offers. We ended up getting 2 written offers. And basically those offers, you would think it's brand new listing, multiple offers, you're probably going to get full price offer. And we did price it a little bit low compared to comps because we needed to move it quickly. But both those offers came in $25,000 and $30,000 under list. That was kind of an eye-opening experience for us. Been doing this a long time. Not sure I've ever seen a scenario where you had multiple offer situation and everybody tried to get 3% off the list price. But ultimately, we did counter those offers, and we got one of them up to full price. But just to give you some context, it is hard to get a big chunk of money off the price. Now, that being said, it's hard to get a lot of money off the price in general. If you have the expectation that, hey, I'm going to try to get $50,000 or $100,000 off the list price of a house, some people have those expectations and some people go into a home buying search saying, I want to find a really good deal. Of course, everybody wants a good deal. The thing you got to understand is if you're not an investor, buyers are typically looking for a great house, right? And because we don't have tons of inventory at any given time in the Northern Colorado market, even though we do have a lot more inventory than we used to, if you take a home buyer out and they're looking for a particular thing, usually at any given time, there's maybe 1 or maybe 2 homes that they might potentially actually buy. So that dynamic really kind of carries over into how much you're willing to negotiate, because you don't want to just buy any home, right? You want to buy a home that fits your family and works, and it's just, it's the right house for you. So while people like the idea of getting a great deal and negotiating a bunch off the house, they have to marry that with the fact that they also want to buy a great house. And those two things don't necessarily always come together. And so, again, the average, 2 or 3% off of list. If you're trying to get more than that, a lot of times it's a grind, right? You got to make an offer, and then the seller's going to counter, and you're going to say, okay, we're still like well above where I want to be. A lot of times you have to let those properties sit. So, for example, a few months back, we got $50,000 off of a $500,000 home. So we got a 10% discount on that house. But it took almost 2 months to get there. We made the initial offer. They said, no, thanks. They countered us much higher than where we wanted to be. And we said no. And we countered again. They said no. We let it sit. We just moved on. We kept shopping for other properties. And over the course of a month, they came back to us. Still was too high. We negotiated again, and we walked away again. And then finally, better part of 2 months after we had made that initial offer, they came back to us again because they'd been sitting on the market and weren't getting other offers. And we were ultimately able to negotiate what we felt was a pretty great price. But it takes a lot of time. So my point is, and that was an investor deal. So, a home buyer buying for themselves, doesn't necessarily have that same sort of intestinal fortitude to walk away from a house that they really like and let it sit and have the potential for somebody else to get it, because they're not seeing tons of properties at any given time that work just right for them. So you got to marry those two considerations and, be realistic with what you're willing to negotiate. Also, if you're trying to knock $50,000 or $100,000 off the price of a home, the seller might be thinking, well, if I'm going to go below the list price that far, why don't I drop the price significantly first and see if that price drop gets us a lot of activity? So that's something that goes through the seller's mind when they're thinking about taking a big price cut on a home. Now, a lot of sellers just don't like to drop the price, so a lot of times they won't do that. But just keep those things in mind as you're kind of starting and trying to understand what you might be willing to negotiate. One thing also to think about is how we price properties. So if you like a house, we're essentially going to do an appraisal on that house in order to help you understand where it should be priced. So we're going to take all the comparable sales around that home. We're going to make adjustments for things like square footage and views and lot size and beds and bathrooms and finish quality. All those things, you can put a monetary value on them. I think a lot of times, home buyers sort of are pricing kind of from the hip, or they're not quantifying specific adjustments. And they might say, hey, this home is, 3,000 square feet, and this home is 1,500 square feet. That one's selling for $200 a square foot. This one's selling for $400 a square foot. They might try to make some of those adjustments, but they don't understand that larger homes are going to have a much lower dollar per square foot because you're spreading the fixed costs of the home over a larger number of square feet. So that dollar per square foot number is going to come down. There's just a lot of different dynamics there that I think should be quantified and should be put on paper so that you can say, hey, we're not just saying this is a $500,000 house, we're going to offer $475,000. We're going to say, what has everything sold for around this house? Let's make specific adjustments for all those things I mentioned. And then what kind of price are we looking at? And that's what an appraiser does. Real estate brokers sometimes do that, but not always. And so we want to be intentional about pricing. Also because it can help us when we're making that initial offer. We can say, hey, we're not just pulling this number out of thin air. We've done our homework. Here's how we arrived at this price, and put it in front of them. And that strategy has helped us negotiate some great deals and I think has just made our position a lot stronger. And ultimately, that's what you got to do if you're going to negotiate the price off of a home. Otherwise, you're just people do think you're pulling a number out of thin air, and a lot of times people are. So keep that in mind. Let's talk about waiting for the market to crash, or at least the fear that a lot of home buyers have that if they buy right now, the market's going to correct 10% over the next year. And we're in a great kind of unique position right now because, I've been doing this about 20 years. So I've seen the market stress tested 2 different times in a very significant way. The first was the 2008 financial collapse where we had all those bad mortgages and there was just a huge number of listings on the market. Actually, interesting point. I've heard some people say that the inventory levels in 2008 are the same as what they are now, which is not true. We have less than half the inventory we had in 2008. So we're not even close to those same conditions. But it is something we can look back at and say, how did the market perform during, the biggest financial crisis that we've had in recent memory? And the median prices in northern Colorado corrected very, very little. 3.5% was about our biggest year-over-year median price change. Certainly there was a lot of foreclosures. Certainly there's people that lost their homes. But it's interesting to watch northern Colorado do what it does as far as maintaining prices. And then you see markets like Phoenix. We mentioned Austin earlier, but right now Phoenix has lost, in 2008, Phoenix lost about 40% of its median price during the same period where northern Colorado was, losing about 3.5%. I'm not sure if let me talk about Austin as well, because that's another interesting, I'm not sure if I talked about that at the beginning. because we've done a couple of these episodes recently, but Austin has corrected from the peak of its COVID prices. Their median price is off about 25%. And right now, Northern Colorado's price correction is about 5.5%. So I tell you those stories to just help you understand that our area tends to significantly outperform other markets. Even in the last two stress tests that we've had, the 2008 collapse, and then now with interest rates spiking, that did have a massive impact on some markets. Austin in particular had incredible appreciation during COVID, and that bubble has burst very significantly, and again, about a 25% median price correction. And Northern Colorado during that same time, our biggest price drop's been about 5.5%. Right now, we are 5.5% lower than our prices were last year in December. So we're in December 2025. December 2024 prices were about 5.5% higher. So we have seen a significant correction, at least in terms of what our market tends to do. But let's talk why. Why does our area outperform those other markets? A big part of that is the ability for developers to bring new projects online, right? You always have this dynamic in a real estate market of resale properties and then new construction, right? Builders have these huge neighborhoods that they can develop over a period of time. Certainly those neighborhoods exist in Northern Colorado. I'm not saying there's no new construction here, but the amount of new construction that we have is significantly less than in other markets, and a big part of that is water taps. So if you're a developer and you're like, hey, I want to put 1,000 homes in this subdivision, and you go to that water district, they will not just sell you the water that you need to tie in 1,000 homes to their water supply. And the reason for that is because they have a finite amount of water, and they have an existing customer base, and they're not just going to sell water taps to any developer because they will deplete their water supply, and in low water years they might not have enough water to service those customers. So they're very careful about that. So the result is that, if you're familiar with our area, if you go up to the Budweiser plant in Northeast Fort Collins, there's a huge amount of cornfields around the Budweiser plant. And there's a massive development called Montava that is about 5,000 housing units that they're trying to put in there. And they've been trying to get the water for that project for more than a decade. And they've been trying all kinds of different ways to do it. But basically the water district only takes water shares from certain water providers. And you can imagine how expensive water rights are on the Front Range. Some years the value of them has been doubling every 2 years. So if you're not absolutely desperate, if you're a farmer and you have a big water right and you're not desperate to sell that, you might wait a couple years and it might go up even more. So pretty hard to find those water rights. Again, you got a massive development like that, and they still do not have the green light to start that project yet because they can't find the water. So it's an artificial, it's a natural constriction on the supply of homes in our area. Of course, there's all the other things. It's a great place to live, great quality of life. The school systems are wonderful. And so, a lot of our clients come from the Midwest. A lot of people in the Midwest, depending on where you are, choose, if they can afford it, to send their kids to private schools because they don't think the public school system is good. And when they come here, if they had 3 kids all going to private schools, they might be spending $10,000 or $20,000 a year per kid on tuition. You can imagine how much additional income that frees up to spend on housing. So another thing is property taxes. Our property tax is half the national average. It's a third of what it is in a lot of high tax states like New Jersey and Illinois and Texas. Our property tax rate is about 0.65% of the national average. So there's even though some people can come here and say, hey, the sticker prices of homes seem pretty high, if you factor in a lot of different things, cost of housing, depending on where you're coming from, certainly if you're coming from California or if you're coming from the Northeast, you might think our housing prices are pretty reasonable. People coming from the Midwest certainly think our houses are very expensive. But if you factor in property tax and, for those with kids, private school tuition, and it balances things out fairly significantly. So those are some of the reasons why our market seems to outperform. Another thing to keep in mind is the seasonality of our market. The first 6 months of the year, from January to June, are when we see the most activity, when we see the strongest market. In other words, the best time to sell a house is from January to June. For whatever reason, particularly after COVID, people seem kind of programmed to start their home search pretty early in the year, right after the new year. We definitely feel a surge of people calling and mortgage applications. So keep in mind that, if you're trying to time the market, buying a home in the last 6 months of the year, so from July to December, tends to be a time when you're going to have a little bit more negotiating power. So if you watch our pricing graph, the first 6 months of the year goes up, and then the last 6 months of the year, we give a lot of those price gains back. And the result of the last few years has been a pretty flat pricing over the 12-month span. Now, negotiating power is not the only thing to consider. One of the nice things about buying in the first 6 months of the year, even if you don't have as much negotiating power as you do in the end of the year, is that you're going to have more product to choose from. You're going to have 3 times the amount of inventory coming online in those, spring months, especially April, May, and June. That's when prime listings are going to hit the market. That's when landscaping looks the best. A lot of people that are planning to sell, that's when they're going to do it. Another reason our price goes up is just because more expensive homes tend to come on the market during that period. But for any buyer, regardless of what you're looking for, that time of year is when you're going to have the most to choose from. And I think for most people, that's probably their priority. Pricing is not necessarily the top thing on their mind. Finding a great house to live in is. So, the market crashing, again, I'm not saying the market can't crash here. And, I was selling real estate in 2008, and there was a lot of people that were underwater, and they'd come to me and say, my house is worth less than my mortgage. And, it's hopeless. I have to sell this house. I have to get out from under this house. That felt like a huge weight on them. Now, some of those people couldn't afford their mortgage, but a lot of them just wanted to sell because they didn't like the idea of being underwater. So it gives me, I think that's a helpful thing to think about when we think about, the market crashing. Certainly I can't predict the future. I can look back to 2 big stress events in our market and see how the market performed, but that doesn't mean that our market couldn't crash, that there couldn't be some catastrophic thing that happens geopolitically that would affect our market more significantly. But the thing that buyers, I think, need to be planning for is to hold a house over the long term. Buying and holding real estate over the long term is about the safest investment you can make. And just like any investment, you're not trying to sell the house when it goes down. And a lot of people in 2008, it's exactly what they did. And if they had held on to that home for another 5 to 10 years, a lot of those homes would have tripled in value. So that you got to plan for holding on to a property minimum 5 years. Ideally, you're going to be in a property for 10 years or more. Let's say you get transferred. Let's say the market crashes and you get transferred to another state. I think you should have the mindset that I'm not going to sell the property. I'm going to put a tenant in there. That's something we can talk about when we're evaluating properties is what will this property rent for? And if I had to rent it, would I be cash flow negative? If so, how much? A lot of people will be break even or cash flow negative a couple $100 a month right now with interest rates where they are. Right now, rates are in the low 6s. We're seeing people lock at high 5s on 30-year mortgages. And then for 5-year adjustable rate mortgages, so you can get a mortgage fixed for 5 years, and then after that, it adjusts. Those rates, we're seeing people lock at 5.5%. So if you do a quick Google search for interest rates, you're probably going to see, 6.5. I even see sometimes a full point higher than what we're actually locking buyers right now. So keep that in mind as you're shopping those rates. You probably could get a rate significantly better than what you're seeing advertised. Okay. Hope that all, I know I'm throwing a lot at you guys, and always feel free to, comment, reach out with additional questions. But I want to kind of move on to, I think we covered the, the mortgage crash or the market crash scenario fairly well. Just understanding that if you're buying and holding over a long period of time, things are going to work out. Let's talk about one more thing as far as crashing goes. The problem with trying to time the market, and I know the internet is hell bent on predicting a market crash. They're saying, "Oh my gosh, the housing market is in for a total reset," and there's a lot of people that literally like make a living on those kind of headlines, and you see it all over YouTube. I mean, they've been predicting crashes for a decade, and at the end of the day, the real estate market tends to be very resilient because it's not the same investment. It's not like a stock market investment. People are not day trading homes. They are buying homes to live in, get married, do whatever. It's housing. It's an absolute necessity. People don't jump in and out of the market. And I think predicting those market crashes, without data. I mean, you look at Zillow right now, they're projecting a 1% increase in prices over the next year. Look at real housing analysts and not people that are trying to get clicks on YouTube. Watch the inventory levels, understand how real estate dynamics like the water tap inventory affects, markets like Northern Colorado. Don't just, watch a YouTube video and, get swept up in that fear. But the problem with those folks, they're not going to buy homes, right? Because they're always going to think, hey, the market might crash this year and I'm just going to wait for that crash to happen. The problem with that strategy is you never know when the right time to buy is. Even if the market goes down, like in my opinion right now, the fact that we've corrected 5.5%, that's a pretty significant correction for our market. And I think the market is going to, potentially appreciate a point or two over the next year. I don't think it's going to be massive. But I think this is probably a pretty solid time to buy. We think rates are probably going to start dropping. That could bring some life into the market. But if you ask somebody that is hell-bent on waiting for a crash, they're never going to know when the right time to buy is, right? If the market goes down 5%, they're going to say, oh, it's going to go down more. And then if it goes up, they're going to say, oh my gosh, I can't buy now. So they're just going to continue to wait. And that's the problem. That's why there's that old adage, time in the market always trumps timing the market, because at some point you have to start your purchase. You have to start building equity in a property, paying down the mortgage, getting the appreciation, doing the improvements that will help the property sell for more ultimately when you do go to sell it. And if you're always waiting for the crash, you're not getting that time in the market, and you never know when the right time to buy is. Okay, let's talk about mortgages. Man, so much to talk about as far as the mortgage process. I want to start with the pre-qualification process. Let me grab a drink real quick. Probably the biggest mistake that we see people make, especially with people that have bought a couple homes, they are confident in their ability. They know they've got a good job. They know they've got decent credit. They know they can get a mortgage, and they will shop for long periods of time without a pre-approval letter. Common thing. I've done the same thing. It's not fun to get a mortgage approval. You got to dig up all those documents. But what we commonly see is people that think that their credit is amazing. When they do end up finding a great house, all of a sudden they're scrambling. Oh my gosh, okay, we found this house. It just came on the market. We got to get it under contract. Then they start to dig up their mortgage application documents, right? And we'll talk about what those are in just a second. And then they get their credit pulled. They didn't want to pull their credit, a couple months ago because they knew there would be a credit ding and they wanted to only do it once. But when they did pull their credit, they found out that their score had dropped from 800 down below 725 because they had some random thing they didn't realize, a late payment, and their credit went from A credit down to B credit. They're getting a worse interest rate, and they're super frustrated. Your credit, when you pull your credit, it's a couple points that knocks off your credit. It's not a big deal. It's not gonna, if that is gonna drop you below 725, you need to know that you're right on the cusp between A and B credit. 725 is typically the threshold where a lender will go from giving you the absolute best rate if you're above 725 to below that, you get a worse interest rate. And a lot of people say, my credit is great, I don't need to, and then they find out that they're getting dinged because they're below 725. So if you pull your credit well in advance of when you're shopping for that home, a lot of times those credit dings can be fixed. Mortgage people are really capable typically at helping you understand what you have to do in order to fix those credit blemishes. So for the price of a point or so, on your credit, get that credit pulled early. And then if it is in need of repair, you can repair it. The other thing is just the stress of trying to get all those documents, your 1099s or your W-2, your proof of employment, recent pay stubs, self-employment documents, P&L statements, balance sheets, 2 months of bank statements are another thing. And then if you own another home, you're going to want mortgage statements for the mortgage. You're going to want a lease document for if you have a rental property that will help you offset that mortgage so it doesn't count towards your debt to income ratio that the lender uses to qualify you. So those are some of the documents that you need to hunt down. Do that now. Also, filing your tax returns is a huge mistake that people make. A lot of times they find a house, then they realize they haven't filed their taxes this year, and so they're trying to get pre-qualified for a house, and in that process they're digging up all these documents, and they're also filing a tax return. So if you're a procrastinator, and you're thinking about buying a house this year, this is definitely something you don't want to procrastinate on, something you want to do in advance. It just makes the shopping experience a lot better too. When you have that approval letter in hand, I think it feels a lot better to shop. You also get a loan estimate, so you know exactly what your mortgage payment is going to be at different price points. You can say, hey, I like this house, send it to your mortgage broker. They can give you a loan estimate so you know exactly what your closing costs are going to be, interest rate, monthly payment, all that stuff. Super helpful to have somebody. So you're not just doing a random mortgage calculator, you're actually seeing real world numbers based on your credit score. Can't encourage you guys enough to do that. So different types of mortgage brokers. Another thing people don't understand is that if there's anything that you are ever going to shop for in your entire life, I think a mortgage is that thing. Mortgage pricing can vary by thousands of dollars. I've seen $5,000-$10,000 differences in loan estimates between different mortgage providers. A lot of people, whoever they have their checking account with, the big retail bank that they use, that's who they're going to go in and get a mortgage through. Those retail lenders use that existing relationship, and they'll charge you more. I mean, they're just not the most competitive typically. Sometimes if you have a credit union, you can get a great rate, but typically the high-profile big banks that a lot of us bank with are not going to have the best mortgage pricing. They're also not going to have mortgage lenders that work on the weekends. This is something that we run into a lot, is that bankers that sit in a desk in a major retail bank, if we need an approval letter written up on a weekend because we're shopping for homes and it's Saturday and we need the approval letter to be adjusted based on the offer that we're making, a lot of times those retail bankers are just not going to be available. Like, we didn't get their cell phone, or we might be going through phone tree hell to try to get a hold of them, and that's just not, I think, what you want. We have a number of different mortgage providers that we recommend. Those tend to be local, either mortgage bankers, and bankers is a loan officer that works with one bank, and they tend to have like the smoothest underwriting process, but not necessarily the best pricing. On the other hand, you have mortgage brokers. Brokers have relationships with 10 or 20 different banks, and they know which bank to go through based on your particular situation. And so they tend to have the best pricing, but they also can have less control over the underwriting process. So the underwriting process is basically they review all those documents, they review your tax returns, they look at all the deposits and withdrawals that have been made in your bank account, and if anything looks out of the ordinary, they're coming to you saying, please explain this. And that process can be a little bit better with a mortgage banker. So sometimes for people that have complex tax returns or self-employed, mortgage bankers can be a better option. Also, sometimes we'll use mortgage bankers that can pre-underwrite a loan. So if you think it's going to be complex, or if you're kind of right on the cusp of qualifying, they can go through the entire underwriting process before you've made an offer on a house. It's the frustrating thing with mortgages, is that there's so much manpower that goes into qualifying you for a mortgage that those banks typically don't want to go through that until they see that you're under contract, that you have a house, you have a contract on a house, you can give them that contract, and they'll say, okay, now we'll start the underwriting process. Now, a good loan officer will run you through the paces. They'll look at all your stuff and they'll do what we call kind of a pre-underwrite, but you're not getting the actual decision makers to go through that and comb through all of your documents until you're under contract. So some of those banks that we work with, they will do that. And when we have a particular kind of complex tax return or a complex borrower, typically those are self-employed, we might recommend a mortgage banker because they're literally working next to the desk of their underwriters. They can correspond with them more easily. They have more access to them, and they can anticipate and pre-underwrite better. But at the end of the day, I know there's kind of a lot of like industry jargon in there. Maybe that's not landing very well with you, but getting your documents together early, getting the pre-qualification process done early, shopping with more than one lender, asking your realtor for recommendations on who they've used in the past, getting more than one recommendation, applying with more than one bank. Those are going to be things that are going to get you a long way, and you're going to be way ahead of the curve, and it's going to feel better to shop, and you're not going to be freaking out looking for documents at the last second. First-time home buyers, kudos, shout out to your first-time home buyers, because they have never bought a home and they want to know that they are pre-qualified before they shop. So it's funny, they tend to be the people that do talk to a mortgage broker really early. They have all their ducks in a row because, it's kind of it's a new thing and they don't know if they're going to get qualified and all that stuff. And so it's funny to see that, the people that have bought 3 or 4 homes tend to be the ones that procrastinate the most. Okay, let's also talk about down payment amounts. I think particularly first-time home buyers, a lot of people think I should save up 20% so that I avoid mortgage insurance. But you can do 3% down. For USDA and VA loans, you can do 0 down. So VAs are obviously veterans, armed services, can get a 0 down mortgage without mortgage insurance. Of course, they do have a VA funding fee, so that's a significant expense. But what I'm trying to say is that I'm concerned that people say I have to save up 20% because I don't want to pay mortgage insurance. But mortgage insurance doesn't have to be a monthly payment. A lot of people think of mortgage insurance as $150 or $200 a month extra payment that they don't want to pay. And that's fine. If you can save up 20%, that's great. But mortgage insurance can also be paid as an upfront one-time fee. And because you have more negotiating power right now, you can typically get the seller to pay some of your loan closing costs or all of your loan closing costs. And so you don't have to pay that mortgage insurance, and it can be paid as a one-time fee, couple $1,000s, and boom, you don't have that monthly mortgage insurance that you're going to pay over time. Let's talk about closing costs and just kind of a rule of thumb for your mortgage closing costs. 1.5% of the loan amount is a good rule of thumb for your loan closing costs. So if you're getting a $500,000 mortgage, 7,500 bucks is probably a good rule of thumb to plan around. But you got to understand that mortgages can be structured in almost an infinite number of ways. So you can take a little bit higher interest rate. So if the normal rate is 5.75, if you choose 5.85, the lender will give you a credit towards your closing costs. So if you thought your closing costs are going to be 7,500, they might drop to 5,000 because you chose a slightly higher interest rate. People are doing that because they think that they're going to refi over the next few years. So that means that they're not going to have this mortgage in place for very long. And so it doesn't make sense for them to pay the $7,500 in closing costs because, if they paid a lower closing cost rate and got a higher interest rate, that actually would save them money if they're going to refinance in the short term. So if you're going to have a mortgage for 30 years, right, obviously having the lowest possible interest rate, even if you have to pay a significant closing cost premium to get that low interest rate, that's what you're going to do. But if you're going to have a mortgage for a short time and there's not a lot of time for the interest to rack up, those one-time closing cost fees become the lion's share of the mortgage cost. So sometimes choosing a higher interest rate and having a lower closing cost is what you want to do if you don't think you're going to have the mortgage for maybe you have it for 2 years or 5 years. But a good mortgage broker is going to be able to run those scenarios and basically say, hey, in 5 years, if you have your mortgage for 5 years, this is the break-even point on, that lender credit is what we call it. Conversely, you can also buy down the rate. You can pay more closing costs and get a lower interest rate. Not a lot of people doing that right now because, again, people think rates are going down. They think they're going to refi, so it doesn't make sense to buy down the mortgage significantly right now. Okay, let's kind of move on. I think we, covered a lot of ground. I want to talk about inspections right now. Let me grab a drink. Man, inspections are something that we've worked a lot at over the years. Let's call it the due diligence process is a good kind of term for like all the research that you do when you buy a house, right? And, over the years, like I said, doing this quite a while and, we've sold over 1,000 homes and over that period of time, I've had the experience where somebody calls me up and says, hey, Ryan, we've been in this house for a couple years now. We noticed this problem and why wasn't it found on the inspection? Obviously, that's like, a phone call that you really don't like to get if you're a real estate agent. But it happens. And so, obviously we're thinking when that happens, hey, what went wrong here? Did the inspector miss it? Or, is this something that we could have prevented? What can we do in the future to eliminate this kind of problem? And we've noticed that, a lot of times the issues come when, an inspector does a general inspection, right? But there's a lot of different things that you can inspect on a house. A sprinkler system, a pool, asbestos testing, lead paint testing, the sewer line. There's a lot of different add-on inspections. And I think the perception that the public has is that when they're ordering an inspection, everything on the house is being inspected. But that is not the case. If you read the kind of, fine print on an inspection report, it'll say this is not an exhaustive report. There's some things that we visually just don't have access to. And so understanding what is being inspected and what is not being inspected, I think is critically important. So, like I said, if you have a pool or a hot tub, if you have a sprinkler system in particular, we're in the Rocky Mountains, so in the middle of winter, you're not necessarily going to fire up a sprinkler system and inspect it. Even in the summer, inspectors don't do a lot of sprinkler system inspections. And so a lot of times people fire up their sprinkler system and they're like, hey, there's a bunch of heads that are spraying everywhere. There's a leak in the system or whatever the case may be. And that's something to understand. We've definitely gotten plenty of calls like that. Sprinkler systems are something that you got to understand. And if you want to inspect a sprinkler system, you're going to have to take special consideration. If you want to inspect it during the winter, done it a couple times, you got to have a warm day. You got to blow the system out again. A lot of people just say, hey, the sprinkler system, I'm going to take it as is. I understand I might have to do some fixes, but that's something to think about. Another thing that commonly happens when an item is not inspected is if the owner of the home has a lot of stuff, and this has happened in crawl spaces or in bathrooms, rooms where the visual inspection was impeded because of stuff, or if they couldn't access a crawl space for whatever reason, if it was locked, and you'll see on inspection reports they might just say, hey, here was a part of the house, it was locked, we couldn't get into it, or there was too much stuff in this crawl space, we couldn't access it. And so it's not been inspected. These are huge red flags. When that happens, you should basically assume if there's anything that's going to go wrong with this house, it's probably going to be in the spot where the inspector wasn't able to inspect. So that should be your red flag warning. Hey, let's go back. Let's have the inspector back out. Let's let the seller know we couldn't inspect this area. That's unacceptable. We need to get the inspector back out there to look at that spot. Sewer lines are another thing that are commonly not inspected, especially on newer homes. An inspector, is going to do a general inspection, but a lot of times on a newer house, they're like, hey, the sewer line is plastic, it's probably fine. But in particular on new construction, we've found a lot of problems with sewer lines, whether or not they had a belly in the line, which is where the line, should be going like this, but there's a low spot in the line and, sewage is collecting in that spot and can create problems over time. That's something that's super important. So just kind of understanding that. Also, again, the inspection is just one part of the due diligence process that we're going to take you through. It's not everything. There's a lot of other due diligence that can and should be done. And a couple examples of that are when you're going to get your insurance, you can do an insurance claim history review. So it's called a clue report. And we've had situations where we have a home under contract. We looked at the seller's disclosure. It looked just fine. The home inspected fairly well. But then all of a sudden, on the insurance claim history report, we found that there had been a massive insurance claim for, a leak. In this case that I'm thinking of, the bedroom upstairs had leaked and the entire kitchen was basically torn apart. Because there was a significant water damage. This is the kind of stuff, obviously, that you would like to know. This wasn't disclosed to us. Thankfully, we did this insurance history search, and we found it, and we approached the seller, and you can imagine, and this wasn't something that happened so long ago that they didn't remember. This was just the prior year. They had clearly not disclosed it. And so they were obviously falling all over themselves, apologizing, and definitely gave us a leg up during the negotiation process. So, stuff like that. I think people have the idea that the inspection is everything that they need to do, but that's certainly not the case. Another thing to keep in mind is talking to neighbors is such an important thing, not only to understand who your neighbors are, especially on either side of you directly, but also just to understand the neighborhood. We've had a situation where, we're looking at this townhome complex and, we're walking around and I see somebody and I'm like, hey, let's stop and talk to them. And I said, hey, do you live here? And she said, yeah. And I said, we're thinking about buying this unit right here. How's the HOA? What do you like living here? Is there anything we should know about or anything we should be concerned about? And she looked at me and she said, I think you need to come in for coffee. So my buyers and I go in and, the lady's telling us all this drama with a chronic roof leak that is basically a design flaw with these units, and they've tried to correct it and they're having trouble, and a bunch of different units have had water leaks. And so, wow, we were really glad that, we didn't, because that wasn't disclosed to us. We were really glad that we knew about that, and ultimately ended up not buying that unit. Also, just you'll hear about situations where people have neighbors that are problematic on either side of them, especially directly, to the right or to the left of the house, and just knocking on doors or going to the house. You're going to be at the house a lot during the due diligence process for, showings and repeat showings, and then the inspection process. You can spend plenty of time at the house. So, what we do often for our clients is talk to neighbors. We encourage them to do it themselves, just to ask those questions. How's the HOA? Do you like living here? Are there transportation projects? Anything like that that we should know about? You'll get a lot of great information from neighbors, and, at minimum, you'll just see if the people on either side of you are warm and friendly, or, how that relationship might pan out. All right. Let's talk about real estate commissions. That is something that, again, agents don't talk a lot about. I want you guys to understand how they work, and so you can best position yourself when you're buying a house. So there was a lot of recently a lot of news about real estate commissions, and the Department of Justice was accusing the real estate the realtor association of fixing prices. So there's a lot of drama around that. There's a lot of headlines. I think a lot of people don't understand actually what shook out from that whole process. So try to break that down for you real quick. Essentially, most homes that are on the market have two different commissions sort of built into the price of that home, right? Most people say, okay, I'm going to have an agent work with me that advocates for me. And then if a buyer's agent comes to my house and offers an acceptable price for my house, I'm going to pay the buyer's agent as well. And it used to be that real estate commissions were advertised in the MLS. So anytime an agent went to a house, they knew that if they sold that house, they knew what commission rate the seller was offering. And so they could plan around that. And it wasn't in the contract anywhere. It was an agreement between the brokers that it's basically an MLS agreement that if you're a member of the MLS and you sell one of our listings, we've contractually obligated with the seller in order to pay your fee. Now, the Department of Justice, there was a class action lawsuit basically saying realtors are fixing those commission rates, and we want to change that. And so ultimately they required MLSs to remove those commission amounts, because they thought if a real estate agent saw a lower than normal commission rate, and normal is subjective, right? People offer all kinds of different commissions. A lot of people think it's 6% only. That's absolutely not the case. Commissions can be set at whatever commission amount you can negotiate with your broker. But the class action lawsuit claimed that realtors were fixing prices because they were basically telling their clients that you got to offer a certain commission amount in the MLS. So they don't allow us anymore to put a commission amount in the MLS, and they thought that would help and allow, basically what they were trying to do is get home buyers to pay their realtors out of pocket. But I think we can all understand that, hey, the home buyer is the person that's coming up with a ton of money in order to buy a house. The home seller is typically the person that's, about to have a windfall of money. So does it make more sense for the buyer to pay the real estate commission or for the seller to pay it? I think most people would agree it makes more sense for the seller to pay it. But certainly sellers don't have to pay a commission, right? They can list their house on Zillow. They can not offer any buyer's agent commission or even work with a listing agent. They can work with a flat fee broker. So the accusation that there was that there's not choice for the consumer, I think is hard for me to believe, because I do know that there's a lot of discount brokers out there that charge lower commission rates and provide, basically just get you in the MLS and don't do a lot for you. But I think probably the best way to kind of articulate how this pans out in the real world is the following. So let's say you see a house that's listed, right? And you go to an open house and you don't have a real estate agent, right? Certain consumers, certain home buyers are thinking, if I don't have a real estate agent, I should be able to negotiate a better price on that house. That may or may not be the case, and that's something that you need to find out. If you're going to go to a house on the open house and make an offer, potentially, if you like it and you're going to offer on that listing, you need to understand I'm not being represented, right? The due diligence process that we just talked about, and we only scratched the surface on that due diligence process. There's a whole bunch of stuff, from the title search to the survey, all the different kinds of inspections that we can do, walk you through all that. Like, that's a lot. It's a significant part of the value, the pricing of the home, right? Who is pricing that property for you? Who's making all those adjustments? Is it the person working with the seller or the person working with the buyer? Now, some people just want to say, hey, forget all that. I just want to buy the house and I want to try to get a discount because I don't have a real estate agent that the seller is going to pay. What you have to understand is that a lot of times those listing agents, if there's a buyer that doesn't have an agent, they are getting paid more on that house than they otherwise would have if you brought a buyer. So you might be saving some money, but you're not saving potentially as much money as you think you are. You need to ask the agent, if I offer on this house and I'm not represented by an agent, is the seller going to pay less in commissions? Therefore, can I get a discount on the house because I don't have a real estate agent? I think that's what people need to be asking themselves in those situations. Now, because the laws have changed and we're no longer allowed to advertise a commission amount in the MLS, the commission amounts are now put on the contracts themselves. So this is, I think, problematic because it used to be if a seller said, hey, I only want to pay a 2% commission, right? They could put that in the MLS and they could say, hey, now everybody knows I'm only willing to pay a 2% commission. What's happened now is that because we can't see what a seller is potentially offering, a lot of times, we just don't know. And so we're going to show the property regardless, right? By law, we're contractually obligated to show the property to our buyer, regardless of the commission amount, if it's something that potentially works for the buyer. And so because we don't know what the commission amount is, we write in a commission amount that we've pre-negotiated with our client saying, hey, if I'm going to work with you as your buyer's agent, when you make an offer on a property, we're going to write in this commission amount that the seller is obligated to pay. So whereas the sellers used to be able to advertise and make it plainly clear to everybody what I'm willing to pay on this house, now they don't. And so a lot of times when they get an offer from a buyer, the 3% commission is written into the contract, and they feel they're a little bit less likely to negotiate that. A lot of times, especially in this market, they're just happy to have an offer. So I think, unfortunately, the changes in those laws, in my opinion, have increased commissions a little bit. Probably not a lot. You'll still see agents making 2.5%, 2.8%, 3% commissions, depending on the situation. But I think while a seller is not obligated to pay any real estate commission, most of the time what they find out, and a lot of people that have done for sale by owners realize that the majority of buyers out there that are serious, that have seen a lot of property, that are pre-qualified, buyers don't tend to just go out and buy the first home that they see. They tend to shop over a period of months, sometimes years. It takes them a long time to get to a spot where they're comfortable enough to make a commitment to buy a house. And the majority of those buyers that have got far enough down the line to pull the trigger on a house, they tend to be working with a real estate agent. So, we find that sellers tend to be better off being willing and open to pay a commission. Whereas if you're putting your house on the market and saying, hey, I refuse to pay any real estate commission, you might sell the house still, but most people just say, hey, I'm going to build it into the price of the home. I'm going to understand that the majority of serious buyers out there probably have an agent. They probably don't want to pay their agent out of pocket. I'm the one that's about to walk away with $100,000 or $200,000. So a lot of buyers think it makes more sense for me to pay the commission. And so, those are just some of those dynamics. when the way that we do our buyer agency agreements, we're not obligating our buyers to pay our commission out of pocket. We know that we can negotiate the commission to be paid by the seller because we've done it many, many times. And, that's our job, is to negotiate. And so you do get an advocate. You do get somebody that has a fiduciary responsibility to get you the best price and terms, to do the best due diligence you can possibly do. And we can build that into the price of the home. So our services are not free. Certainly you are paying, even though you're not writing us a check when you utilize our services, you are paying for our services in the price of the home. And you can understand, you can look around at all the homes that are on the market. Typically those homes are priced in such a way where the seller is assuming that they are going to pay a buyer's agent commission. So it's usually not an issue. But if you are, the kind of person that wants to try to negotiate the buyer's agent commission out, again, if you're going to buy a home that's represented by a realtor, I would ask them specifically, how much am I saving by buying this house without a real estate agent? And if they won't tell you, I think that's a red flag. I think at the end of the day, if you can't understand how much you're saving, or if you're saving a small amount of money, certainly I think it makes the most sense to get your own representation, so that, if a commission is going to be paid either way, you might as well have somebody that's advocating for you, because the seller's agent can't advocate for both parties, right? They typically have a personal relationship with the home seller. A lot of times it's friends or maybe even family. So you're going to be getting the short end of the stick in that negotiation. You need a fiduciary, essentially, somebody that's legally bound to get you the best price and terms for that home. So, okay, guys, we've obviously covered a lot. Appreciate you guys. I mean, I think that gets us kind of at a lot of what we're talking about initially with clients. Of course, we're talking about, their home search. Is it realistic to find what they're looking for? That's another thing a lot of times we do is, if somebody has a certain set of search criteria and they look on the market at any given time, they might not be particularly thrilled with what they're finding. Understanding that we don't have a huge market here. Like I said, in our entire county right now, about 1,200 properties on the market, and it can get as low as 300. That's not a huge amount of inventory. So the mindset that we encourage our buyers to have is shop over the course of months. It's hard to come into town from another state for a weekend and expect to buy a house. Makes a lot more sense. The more time you spend here on the ground shopping for homes, or, we do a lot of, video tours. If somebody's out of town, we'll walk through a house with our phone, maybe a FaceTime call if we get good enough service, or at minimum just record a video and send it to them. You got to be doing that over a period of months in order to see a bunch of great properties. They will pop up. They typically tend to sell, fairly quickly. But just getting a one weekend snapshot of the market, can be discouraging, because there's not necessarily a bunch of homes that you're super pumped about. So have that long game mindset for your home search. Have the mindset that I'm going to put myself in a position to be flexible. If your lease is ending, asking for a month-to-month lease, or if you're relocating here, we have furnished month-to-month rentals that are typically cheaper than an Airbnb. They're fully furnished, so you can have your stuff in storage. You can come here, you can pay 30 days at a time, and you can cancel that lease at any time. And that gives you ultimate flexibility and allows you to be comfortable and kind of be here on the ground instead of understanding what our city is like. That's a huge hack there. So if you guys are interested in those short-term rentals, be happy to put you in touch with those. We got plenty of those. They're anywhere from $3,000 to $4,000 a month, depending on what you're looking for. So hope this has been helpful, guys. Again, my name is Ryan Jenkins, Gray Rock Realty. Appreciate you tuning in and spending some time with us to understand the intricacies of a real estate transaction and understanding the complexity. And this is what we do day in and day out. And this is kind of our world. So it's fun to talk about this with you guys. And, if you're interested in talking more and getting face to face or having a phone call or a Zoom call or whatever, please reach out. Thanks so much.